It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I'm your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
So after a surging U.S. stock market in 2023 and 2024, what lies ahead for 2025? So what does history tell us about markets after 20% consecutive returns? And how should you position your portfolio for both offense and defense this year? That and more coming up on this episode of The Wise Money Show.
That's right. That's right. Investment planning is one of the 6 areas of your financial life. It obviously gets a ton of attention, and we love it. We're going to talk about some geeky stuff right now. But really, how does your investment strategy fit with the other areas of your financial life so that you have synergy and you are making wise financial decisions? If you have a question for the program or want to reach out to us, we'd love to hear from you. You can call or text us 574-222-2000. That's 574-222-2000. Online at wisemoneyshow.com is where you can find us. And then all over social media, wherever you're at, we are there as well. Search The Wise Money Show. All right, so I already said we're numbers geeks. My least favorite statistics analogy. If you flip a coin, say 5 times in a row, and it's heads every single time. On the 6th coin flip, what are the odds it's heads?
Sounds like it's 100%.
That's right. You got to streak going, man. Keep
Vegas.
it going.
Go to Vegas. It's 50%.
That's right. You're baiting us there, weren't you?
And I hate that. I just because my mind says, no. That's the wrong question. The question is, what are the odds of flipping a coin 6 times and having all of them be heads? And so I want to argue with that logic. Mm-hmm. So
I get it, and math plays tricks on all of our minds, right? And
yeah,
especially when it's the stock market involved. You put dollar signs in front of that, and even more. We're all twisted up in knots and everything.
So figures lie, liars figure. That's one of Kevin's favorite sayings. But yeah, the stock market, we've had some jitters in January, and we're a month in. But when you look at last year, unbelievable year in the markets.
Yeah.
The average, long-term average of the stock market is 10%. It was over double that. But that's after having an incredible year in 2023 as well. So what does history say? Does what go up must come down? Like whatever, is that Newton's law? I'm not sure. Aristotle? I have no idea. That was a joke. But is that how it works? What does history tell us about what happens after a 20% return in the market and really after 2 20% returns? But let's start with just lay the foundation. What happened in the markets last year?
Well, yeah, if you're paying attention to your investments, you are high-fiving, you're excited, most likely, because if you have any exposure to the U.S. stock market, then your portfolio it got dragged higher, wasn't it? Mm-hmm. It was a good year in the market, maybe surprising to a lot of folks, but of course, not all of your investments were tied to the U.S. stock market, but that portion you would expect that piece of the portfolio to have been up around 25%.
Yeah, large cap stocks were up 25%, S&P 500. Now, really, that's just a couple of names attributed to most of that. We'll get into that. That's a headline in and of itself. But that really was the clear winner. I mean, second in line in your kind of variety or your diversified portfolio was small cap stocks being up 11.
Yeah, so less than half.
If you hedge, well, my investments should be up 25%, then actually you're probably not high-fiving because you weren't. A diversified portfolio, you were likely up around 10% because large caps up 25, small cap 11, but then international only up 4, bonds barely positive, right? Real estate up a couple percent. So you mix that all up, and it was a good year, above average, but large cap stocks well above average, over double their average.
Well, it stands out to me as well that all of the flavors of investments that you may have in your portfolio had a positive year. Doesn't mean they were up double digits, as you're pointing out. The U.S. stock market, whether it was large or small, those were up double digits. Everything else in the world up maybe single digits, low single digits even. And you throw all that together in a portfolio, and yeah, you're right. A diversified mix of investments may be disappointing. You're not necessarily bragging about how awesome of an investment picker you were.
Right.
And yet, it was a good, solid year for most of your goals and the portfolio performance as a whole.
So let's go back to it then. The coin flip question. So the average in the S&P 500 is around 10%. Okay, so going back to 1950, when the stock market has a 20% return, a double, 20% or more, what are the odds the next coin flip, the next year, is a positive year?
Yeah, it's most of the time. In fact, 4 out of 5 times, 81% of that second year in a row is up at least positive. And it's up very positively, up over 10%. And, to me, there have been some times, not very often, that you get 2 20% years in a row.
Right.
And that's really the statistic that you're zeroing in on here. Unfortunately, that often occurs in a bubble, though.
So going back to 1950, if you happen to flip that coin and it's a 20% year, it's very rare that the next year is up 20% or more. That's only happened 4 times. Mm-hmm. All 4 of those, the market's been positive the next year. So you're thinking, well, then this is gonna be great. Well, 3 of those happened during what we call the tech bubble, and so history doesn't say what goes up absolutely will come down, and in fact, history says with just a few examples that there isn't anything to fear. But you should still be cautious for sure.
For sure, and really, when you look at this, it's a little bit confusing because most folks, when they say what should I be looking at? Should I be looking at these things? And we're gonna peel them apart a little bit and look under the hood and say what happened. But really, what you want to be looking at is over the long term. Are my investments structured? Because this is the problem. Even as I'm sitting here listening to you guys talk right now, I'm thinking, well, wait a minute. If there was one asset class that was up 25% and one that was up 12%, what I want to do is get rid of all the 12 and put it all in the 25. Mm-hmm. And that is my instinct. That is our clients' instincts. That is everyone's instinct, which is what means we're all hardwired to be horrible investors, which is why human beings have survived all these years. Mm-hmm. It's great for survival instincts. It's not great for investment strategies.
Yeah. Yeah, and part of that is, we have had, speaking of just diversification, this has been a stretch here where large caps have outperformed small caps at a pretty unprecedented pace. Same where large caps have outperformed international stocks by a pretty unprecedented pace. And what it's led to, and I'm not trying to be contrarian, again, what goes up doesn't need to come down. I am expect averages to end up playing out long term. And right now, there is significant concentration risk. The U.S., this is going back. I don't know, Josh, if you remember this. I was doing this geeky mental exercise yesterday. I think at the beginning of my career, our career, the U.S. stock market as a proportion of the entire global market was close to 50%. Mm-hmm. What is it now? Do you know?
I don't know.
65%.
Wow, that's
highest it's
crazy.
Ever been. So if you're just going to invest in the entire global stock market, you're getting 65% U.S. stocks. That's a lot. What's the second highest? Around 5%, right? Like it is the world stock market is extremely tilted U.S. And you might say, as it should be, and I would agree with you. And it creates a risk. And then if you say, well, okay, go under the hood of the stock market, the largest, Mag 7, okay, the largest 10 holdings of the S&P 500, but even the Mag 7.
And so in a jargon-free zone, the Mag 7 would be?
The Magnificent 7.
Whoa.
Go ahead.
So no, it sounds like a movie to me. And please don't call me. Go ahead. You go ahead.
NVIDIA, Apple, Amazon, and the likes of those. They accounted for more than 50% of the return last year. So if you held 493 stocks of the S&P 500, mm-hmm. but you didn't hold those 7, you didn't get a 25% return last year. You got significantly less than that. Those 7 stocks, those 7, I don't know, whatever, lifted the entire thing. And now those, and that the biggest 10 make up in a significantly high percentage of the entire index. So it creates a risk. And what about risk? Volatility, we didn't see much of the past 2 years. Will we see it again this year? How should you position your investments? We've got that and more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning. Also on podcasts at the same time, and also on a couple local radio stations at the same time as well, which is why the content's broken up the way that it is. There's segments and talk showy and all that sort of stuff, and we take tangents and all that stuff. If you are, if that's not your pace, if that's not your speed, good news. We've got next wise step videos that air all throughout the work week, every single week, right here on this channel as well. So 8 minutes, 10 minutes, something like that, taking one financial concept, applying it to your financial life. So we've got that pace here as well. Make sure you hit that subscribe button, turn on notifications, so you're made aware every time we drop new content. If you like the content, thank you very much. You comfy over there, Kevin? That was smooth. I actually would have gotten it caught, like in.
I'm hoping someday when we make it that we'll be able to have a studio with
the right temperature
control. Yeah, I mean, it's not that I mind doing this show when it's 300 degrees in the room. I think it's excellent. We just need some cedar paneling on the walls, and we'll just call it a sauna.
Yeah.
Call this our heat exposure.
Yeah.
And
well, when you put the vest on right before we record, I thought that he's going to regret that.
Yeah.
So.
I don't know how you held it together.
I would have been like, okay, stop. Nope, I can't do this.
No, I know. Well, I thought that this cord was through the sleeve hole, and I thought the maneuver was going to be much more technical, and I kept thinking I'm going to try, and yet I couldn't. I felt like I had a stiff neck because there was all this tension in my cord. So anyway.
Okay, so we're gonna pick it back up with predictions, but we still have another segment of just sort of bantering before we get into what drove the market, and then what should you do about it. So predictions, predictions, and then themes, volatility, that sort of stuff. All right. What are your expectations for this year in the stock market? January's had some volatility, but what do you expect? And more importantly, maybe, what does Wall Street expect, and should you even care? We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name's Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com. Then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. It's an incredible year last year in the market. Everyone predicted that, right?
No one.
Not a chance. In fact, if you rewind the tape, 1 year ago, we were talking about, is it even safe to invest in an election year? And we were trying to use the same rationale that we're using right now. Not our gut, not our instincts, not our, just unbelievable wisdom. No, history. What does history say? And history said, yeah, no, green light, green light. The election years are tend to be good years in the market. You can't promise anything, but tend to be good years. And so hang tight, hang with it, despite your political feelings. The markets tend to do well during election years. And that was well undersold because it just skyrocketed last year. And yet that was very much unexpected, even by Wall Street and the forecasters.
It's such a profound question, actually, that you asked, like, what are your expectations for this year? And maybe expectations for your portfolio in general. And that is incredibly important for you to wrestle with, because sometimes our expectations can get skewed on us real quick and we don't even realize it's happening. If you look back over the past 6 years in the market, 5 of the 6 have been way above average, nearly double what the long-term averages have been. And that starts messing with your mind a little bit. And if you've not been a long-term investor, maybe you got started at just the right time in your career, and all you've really known are mostly positive years and very positive years, you start to kind of assume that the market almost always goes up, and it goes up big. And of course, that's not true. We know that there's stretches where it's down for a while, or it kind of bumps along and it's very mediocre. But again, like it starts to mess with your mind, even just looking back at your own personal history. Mm-hmm. And it doesn't help when you've got professionals that are out there saying, oh, yeah, it's definitely going to be up or definitely going to be down, because they can skew your thinking as well. Mm-hmm. But all those professionals got it wrong last year.
And I think, and I'm not, if you're a fan of the Wise Money Show and you've heard us do our investment update the past several years, I always am going to ask the guys what they're going to forecast, and we'll see how they answer. But we always joke and say we don't play that game. No one can predict the future. I'll give Wall Street a pass for last year, though, because there was big expectations about about inflation and interest rates and so on. And the thought was, well, because interest rates rose so quickly in 2023, rates are going to have to come down in 2024. And that's probably because the economy is going to be slowing, and that could lead to a bumpy ride in the stock market. The experts were expecting a very mediocre year last year, barely positive. Some even forecasted negative returns. Instead, it hit a grand slam, up 25%. What about in 2023? The average forecaster expected maybe up 5%. A lot of them were expecting negative returns in 23 because 22 was awful, right? No, crushed it, up over 20%. And in 22, forecasters expected average returns. No, well below average, right?
Bear market.
Forecasters, they're guessing. No one knows the future. So what are they predicting this year? They're actually predicting. I mean, when you get it so wrong, so like
are they gun shy? Or?
No, they are going for it. They're like,
right.
yeah, market's going to hit a triple this year. Maybe bounce one off the wall. Like, so they're expecting huge returns. Like the average now, tons of different Wall Street firms, J.P. Morgan, Goldman Sachs, UBS, blah blah blah. I think the average is close to a 17% rate of return is what they're expecting, and here's my guess. They're going to be dead wrong. I have no idea if they're going to undershoot it or overshoot it, but they're going to be dead wrong. Forecasters, they don't know the future. The markets are wildly complex, and there's no way that you can stand at the beginning of the year and predict what the market's going to be at the end of the year when there are so many like just issues that will pop up and responses that will pop up, and it's just impossible to know. So stay the course. I guess that's the mantra. Stay the course. Make sure that your investment strategies are connected to your financial plan and not just all out in left field. Okay. Make sure it's the right risk tolerance for you and your financial goals, and stay the course. We're going to get to this in a minute, but legendary investor Howard Marks famously said, every investor has a decision to make. They're going to decide how much offense and how much defense they're going to play. Mm-hmm. And you make that decision and then stick with it. Revisit it every once in a while. Just make sure, hey, blah, blah, blah. But not when your emotions tell you to. Stay the course. We'll get to that more.
Yeah, I mean, if you talk about legendary investors, who comes to mind immediately, and it's Warren Buffett. And I can go back 10 years ago, and what did he say? Over the next 10 years, we're gonna have low single-digit returns, averaging. And so even Warren Buffett does play offense and defense. I mean, he plays some meaningful defense. If you look at the $150 billion of cash or something like that, he's got a lot.
As a percentage, apparently more cash than they've ever held, and so.
But even he was wrong on the low side.
Yep.
So.
I'm glad, though, that you're pointing back to the decision on what should your expectations be for your investments. How do you posture yourself? Are you leaning offense or defense within your portfolio? It has to be tied to your long-term financial plan. And that's what helps get you elevated up above just what do you think is going to happen in 2025. because at some level, it's not going to matter. You know, if we were to quiz people on, hey, what were the returns of each of the calendar years throughout your entire working career or whatever, some people only have 5 years to lean on. Other people would need to look back 15, 20 plus years, and they're not going to get most of those right.
Yeah.
You don't remember what happened in the past, and it doesn't really matter. What matters is that you, as you said, stay the course. But the course and defining what that is within your financial plan, it is what forces you to think long term and not just care about what's 2025 going to do for me.
Okay. Well, you asked it. Well, what's 2025 going to do for you? Yeah, guys, is there? You have a prediction? Or at least, yeah. What do you think?
My prediction is the stock market's going to go up and down in 2025. Now, and if you ask me where are we going to end, this is why. And Mike and I were on a conference call yesterday with an investment firm that we listen to a lot and subscribe to some of their investment philosophies, and they refuse. It's kind of funny to me how they refuse to predict, but they will point to everyone else's predictions and how
Kind of like we're doing.
and how horribly wrong they are. If you told me that the stock market is going to do 10% this year, I wouldn't be surprised.
Yep.
But I don't know. And this is the thing that as I'm thinking about this, when you look at what the stock market has done or what I think the stock market will do or go on down the line, I still come back to what do I have control over? Mm-hmm. Because if I'm focused on the stock market and what it's going to do or not do for me in 2025, it's quite possible I'll miss the boat because I'm not focused on the right thing.
Yeah. Yeah.
You know, a lot of people, because we just came through an election cycle, they're going to look at, okay, in the first year of a presidential term, what does the market typically do? And the problem with doing that, yes, you might find some optimistic news if you zero in on just the political climate, but there's just more that drives the market than just what year are we in a presidential term, right? Yeah. It puts too much credit or responsibility at the feet of the president of the United States. Yeah. And so there's just a lot more happening. I tend to try to temper my own expectations, and one of the ways that I kind of pour a little cold water after a nice long run is I just look at, well, is the stock market priced expensive right now? And when the stock market is priced expensively, that can sometimes create a headwind. It's hard for it to keep on making money at this type of pace without a pullback. And so I want to emotionally be ready for a pullback, but I want to be positioned in my portfolio for long-term growth. And so this is more about just managing my own expectations.
Pessimistic short-term, optimistic long-term. If you just default to that, tends to be good. So, all right, we got more coming up here on the Wise Money Show with Korhorn Financial Group. All righty. Off air, but on YouTube. I wouldn't be surprised if we touched in the S&P 5500. I do think we'll finish above 6,000. But there's a whole bunch of risk out there. So I would say below average positive returns, but volatility coming back.
Sure.
Good description.
But there is a countless number of things that could totally change that view. And so why? Because I think the economy will continue to chug along with the consumer barely holding on. But valuations are stretched. The market's expensive at the moment. Mm-hmm. So, but that's logic. Market doesn't move logically every day, every week, every month, and every year. Typically, it moves logically every decade or 20 years.
Yeah, it can go from expensive to more expensive. Yeah. It can stay expensive for a long time.
Well, so. Yeah, I mean, if you say the consumer is just barely holding on, what I sent you guys this morning.
Oh, I know. Yeah, I saw something similar last night.
Yeah, so, and what I'm referring to is just the number of consumers who are making the minimum payments on their credit cards, the share of card holders that are 30 days or more past due, and the rising delinquency rates. So it suggests that there's there's some underlying issues.
Here's what it tells me, and this is soapbox. And Josh, we don't have time for a long break. It suggests the middle class is shrinking and getting squeezed. That's what it tells me.
Mm-hmm.
Because people are spending a lot of money, and then other people are totally on the edge. And hasn't that always been the case? Sure, but middle class is shrinking and getting squeezed. So, all right, here we go. Third segment, we're going to mash together what's going to drive the market and volatility. We'll mash that together, and we'll probably start getting into, so what should you do? And then the fourth segment will be everything, what should you do in the market? So here we go. What's going to drive the markets this year, and will we see volatility come back? I'm just going to tell you, there's a price you pay for the returns that you get in the market, and I don't think investors have been paying that price the past couple of years. So will you pay it this year? All right, we're talking about that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast wherever you listen. Search the Wise Money Show, subscribe to it there, follow us there, and rate the program there as well. We appreciate it. Helpful feedback for us. We're focusing on the investment world to start the program today. And yes, investment planning is one of the 6 areas of your financial life, but it is not financial planning in and of itself. It's not. It's just one area. You're investing for a purpose, and your investment strategies need to be connected with your tax plan, needs to be connected with your cash flow plan, it needs to be connected with your estate plan, right? So it's just one area of your entire financial life. But yeah, you got to get it right. You want to get it right. Guys, what's likely to drive the markets for the year ahead? We've been talking about expectations. Why are those important? Because if your expectations are missed wildly, it could actually cause your emotions to say, I'm going to make it a drastic change, right? If my expectations are Wall Street's going to be right this time in their predictions and the market's going to be up 17%, and instead it's down 17%, you could make the fatal mistake of saying, yep, I'm done. Nope, I'm getting off the ride, and that's it. So what should investors be looking for as the financial headlines to drive the markets this year?
Well, it's been said that short term the market is a voting booth and long term it's a scale. So there's a couple of questions out there. Number one is, will profits matter? All this money has been piled into AI and artificial intelligence. What is it going to do? What kind of traction are we going to get? And will profitability matter? Because if you look at some of the valuations on some of the stocks, I mean, NVIDIA is an easy one to pick on. You can't get there from here. If you look at what NVIDIA has to do performance-wise to justify their valuation over the long term, you can't. It doesn't make any sense.
Well, so I'll just ask a question. Sorry, Josh, for cutting you off. But if you just look at the market, and I were to ask you another question, okay, companies that have more profit, so more cash flow, all that sort of stuff, should they have performed better than companies that had low or no profit? Yeah, well, logically, yes.
Right.
No. If you look at the market, companies that had less profitability or lower profitability just crushed companies that were more profitable last year.
And ultimately, that's because as investors are making their choice on what they're going to own and what they're going to shed out of their portfolio, they are making a bet on what is the future profitability of these companies. So whether that's a company like NVIDIA that's driving the AI revolution here, the assumption is that, yeah, they are massively productive right now, but the future is so much brighter that it's worthwhile to get a piece of that company now at these prices, because look where it's going to go. It's going to go to the moon. Yeah. That's the story that you have to tell yourself. And it's not that different than the language that was being spoken in the late 90s, early 2000 range, where the revolution that was happening there was, if you were a brick and mortar type company, you were dead and just didn't know it, because the internet is going to eat your lunch, right?
Yep.
And eventually that has become true. You know, a lot of the web-based companies that are just powerhouses today, they have put some small companies out of business. And so eventually some of these trends do play out. But in the short term, yeah, you see the prices that companies are trading at right now, and you think, man, how profitable are they going to have to be out there in the future to justify what is being purchased right now, prices that we're paying?
I'll give the counter argument, even though it's not what I feel inside. The counter argument is just like the tech bubble, they were right. They're just early, and things got inflated. I do think we are really still early in the AI and robotic.
Oh, for sure.
We have no idea, guys. I have no idea if they're right, but in a decade, instead of buying a Toyota, you could, for the same price, you could buy a robot in your house to do all the cleaning and everything else. I mean, that is wild that we're going to see that in our lifetimes. And it seems very, very early. And the other thing, when you look at these Mag 7, the amount of free cash flow that they're generating and their earnings growth has been unbelievable. Yeah. Versus in the late 90s, the companies that were soaring had no profits.
That's right.
And even
sometimes no sales.
Correct. Where here it is, they are generating a ton of profit and a ton of revenue, and the expectations are just lofty. So I think another thing that's going to drive the market, inflation, interest rates, again, and I'm so sick of talking about it, but listen, there's no way to not talk about it when we print $6 trillion and throw it in the economy in 3 weeks and see, hey, how's this going to work out? Well, we're still playing that experiment. And then that's connected to government spending, which obviously is connected to politics. But I think those three things certainly will drive the market.
Those are exactly the three that I was hitting on as well. And they are interconnected. I mean, even government action related to AI. Is the government going to be incentivizing further investment in this area, eliminating some of the roadblocks and so on, bringing more of the production to the U.S.? You look at Trump's, at least his rhetoric around tariffs and everything. Those tariffs have spooked some economists saying, oh, no, it's going to create more inflation. And, when some of those tariffs even are mentioned in the context of, hey, threats to Canada and Mexico because we need them to close the border. That has nothing to do with the economy. It's using our tools to help influence our neighbors, right? Yeah. And so it's difficult to predict how much of this is talk and how much of this will actually come into reality. But that's what the market's going to be watching is all the talk on the campaign trail, how much of it actually plays out.
That's a good segue into a universal truth to investing. And that is there's a price you pay for those returns. There's a price that you pay as an investor. And Kevin says it very, very well, and I've stolen it and made it sound like I'm the one that came up with it. That volatility is not a bug in the stock market. It's a feature. That's normal. Normal behavior is some chaos at times, some volatility. And how that plays out on average is that from some high point to some low point at some point during the year, on average, we see about a 14% decline. On average, you're going to grab a statement and say, what in the world? Did the wheels just come off here? That's going to happen on average every year. But here's the point. Didn't happen last year. You didn't pay a volatility tax last year. Didn't happen the year before.
You actually did, but it was a momentary. If you weren't paying attention, if you were on vacation for 1 week, or you were, I don't know what keeps you busy. If you were just trying to figure out the Wordle, you missed it. And so this is because the other thing is after a year where the stock market's down 18% in 2022. You have a positive year in 23. You have a positive year in 24. Now you're 3 years closer to retirement. You're looking at your balances. And it's not going to take a huge downdraft for people to look and say, I can't afford to give up all the ground that I've made.
Yeah, because a percentage decline on a larger number is a larger numerical decline, right? A 10% decline on $100,000 is very different than a 10% decline on $1 million.
And that's math that you have to do periodically. it is part of bracing yourself for the inevitable dips in the market that occur.
Yeah.
The next time we have a 10 or a 15% decline, what will that mean for your portfolio? Like, convert it into actual cash. Are you down 100 grand? Are you down 200 grand? What does it actually mean? And you have to brace yourself for that, because it's going to happen. It's not just going to happen between here and your retirement. It's going to happen periodically in your retirement as well.
Yep, absolutely.
So yeah, the risk to positive years year after year is that we do get lulled to sleep on this volatility reality. And you start to forget sometimes that, the market goes up and down. And what does that mean to my portfolio that is the largest it's ever been in my lifetime?
So what does that mean? You need a plan and a coach, right? To navigate this, because your emotions are going to be tested. Your logic, your sanity is going to be tested. Your future might change, and like life's going to throw you curveballs. So you need a guide, you need a coach, you need a plan. So you need a CFP.
Yep.
All of this is leading towards, well, okay, what adjustments do you need to make in your portfolio? We've got that more coming up on the Wise Money Show with Korhorn Financial Group. All right, Lindsay, for obvious reasons, I feel like we're going into the sixth segment. We're going to the fourth. Got it.
Okay. Well, I actually, we were talking about what we're expecting to do well, and I wanted to hop in because we were talking. I mean, if you look in 2021 to big pharma, now we're talking about big tech / AI, and no one has mentioned in 2025 big chicken. Because if you look at the price of eggs right now, my net worth has increased 72% just due to the 30 chickens that I have in my backyard. I can't believe it. I feel like, and this is the tricky thing. The question is, do I sell them all right now, or do I hold some of them and hope that it goes even higher?
Yeah.
What is the shelf life for those eggs?
And what's the life expectancy of those chickens?
That's
the other
right.
challenge.
All right. So fourth segment, all about how do you apply this? So what do you do? What action do you take? So I'll kick it off with that same offense defense quote, and then we'll get into it. We got 10 minutes to talk about that.
Let's do it.
Here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a ton of other content. I can say a ton. It's over 1,000 now. Or what is a ton? 2,000? 1,000 videos or so on the YouTube channel. Go check it out. Go to YouTube, search the Wise Money Show, subscribe to it there, turn on notifications so you're made aware every time we drop new content, because it's not just this talk show but every single day of the work week, we're dropping a new video, more content to help you take your next wise step in your financial life. Go to YouTube, search the Wise Money Show, subscribe to it there. Okay, focusing in on the markets, but here's where we're going to sort of expand it, apply it to you. We had a lot of banter about what's happened and what's history say and what's pushing the market. Now, what do you do? And it goes back to legendary investor Howard Marks. And I can't remember when he said this, but he said it a few times. And it's just that sort of piercing, really simple statement. Kevin, you've said this is the biggest financial decision anyone makes in their life.
Yes.
But your emotions like challenge that decision every day or every season. Oh, is it still the right one? Do I make a change? Blah, blah, blah. And that is every investor has a choice on how much offense and how much defense they're going to play in their portfolio. In the sports analogy is this is not football. Your investing is not football where okay, nope, we've got the ball. Let's put our offense out. Oh, nope, we don't have the ball. Let's put our defense out. It's like basketball. I prefer hockey, where you're throwing a certain amount of players on the court, and when you've got the puck, you're trying to score all of them. And when you don't have the puck, you're on defense, and it's back and forth. You're playing offense and defense at the exact same time. So how much do you pull the goalie? Do you have goal scorers on defense? Chris Letang, those folks, or do you have more defensive-minded offensive players? How much offense, how much defense? What do you do with all this information?
The way that I frame this with clients over the years has been, let's talk about 3 different levels of risk that we need to consider within your portfolio, within your overall retirement plan, your financial plan in general. One is there's a certain amount of risk that you need to take in order to have growth potential for the future. In other words, there's a certain level of growth or rate of return that you need to have as a possibility for yourself. And you can only get that if you take a certain level of risk. You're not going to get the kind of growth that you need if you're sitting only in CDs, and that's the level of risk that you're taking. So mathematically, what is your retirement plan? What is your long-term financial plan just need to be able to achieve? And there's a level of risk that goes along with that rate of return. But there's also a level of risk that you can afford to take. And some people can afford to take much more risk than what they even need to. And, that can almost bait you into taking bigger risk, buying more growth-oriented investments than is even necessary to achieve the overall objective. And then there's others who, honestly, like at their stage in life, they can't afford to take a ton of risk just because they don't have maybe the time or the resources to bounce back from. Maybe they don't have the liquidity to use other resources beyond just their portfolio that we're investing in. So those are two. And then the third is, what is the level of risk that you can actually stomach? Emotionally, what can you handle? You might need to be taking more risk in your portfolio to achieve your goals, but emotionally, the roller coaster ride that might put you on is one that you will want to be tapping out of. You want to get off of very quickly. Maybe others, it's the opposite. They can handle tons and tons of risk, but they don't need to. The point is that it's sort of an aggregating. It's this balancing act between the levels of risk that should be driving your overall retirement plan, your overall financial plan. And that's why this is such an important conversation for you to be having with your certified financial planner. Now is the time for you to be having that conversation because the market's been going great, and you don't want to bait yourself into having these types of decisions made when the market gets choppy again and your emotions get stirred up.
Yeah, and if your portfolio went from 700,000 to $1 million in the last 2 years, are you okay with watching it go back to 800 before it goes to 2 million? Because if you aren't, you definitely want to be thinking, hey, I'm going to get some defense on the ice.
Yep.
I prefer rugby because rugby.
You're the only one.
Like the beautiful game of soccer, it's constant. I mean, you have goal scorers in soccer, you have your forwards, but really I'm constantly playing offense and defense. But if you said, hey, I'm going to put a chalk behind the wheel so that the wagon can't roll down the hill, know that's going to cost you something.
Yeah.
And you will give up something. And so this is the tricky thing, because if you go back to October of 2022, when peak to trough, the market was down 25%. All anyone wanted to do was to put more chalks behind the wheel so it couldn't go down any further.
Yep.
And all the market has done since then is go straight up. So people look and they say, yeah, but look, I paid to have this kind of insurance that my wagon won't roll back down the hill, and it didn't do me any good. And I say, yes, it did. It did exactly what it was supposed to do.
Right.
But this is where you have to, and I would encourage you, if you're listening today, you have finite time and energy. So invest that time and energy in the very best place, because you're not going to have much control over the stock market. You're going to have 100% control over your investments.
Okay, I'm going to say that a little bit differently. Both of you guys, I'll interpret it a little bit differently and hopefully punch it. I think what I heard from Josh is make sure that your portfolio, your risk level, and your allocation is connected to your financial plan and your goals. So the risk reward that you need. and your own stomach and volatility. My own risk tolerance. I can handle this. So that's one, and that might involve a rebalance right now, right? Just to snap things back to where they are, so that risk reward trade is consistent with your plan and your appetite. So that's one. Second, and this, Kevin, you said it, and we're going to talk about this more later this year. When you're looking at playing offense and defense, you need to reevaluate who's on defense and how you're going to play it. And so you might want to inject some new strategies into your portfolio where the typical defense is bonds. Bonds rarely score. You might look at the previous 45 years and say, 40 years they scored a bunch. I know. That's not normal. It felt normal. It's not normal. Bonds aren't going to score a lot of goals. Okay, but they're going to be really good at defense, right? I don't know. And history has shown there's a lot of times where they're not. They actually just kind of trip. And so, wait a second. If there's these outsized risks, how do I get some defenders on the ice that really can score, but really will play defense when we need them to? And we've got some strategies that we've been using now, and you might want to add some of those types of strategies that it's more clear, yep, in this environment they can score. But when I need defense, I know it'll be there. And Kevin, to your point, the past couple of years, you've had defenders and you haven't needed a lot of defense. And so it might have felt like, I should have had all goal scorers. No. They were playing D. There just wasn't a lot of defense to be played. You're going to need to play defense in the future at some point. So rebalance, 1. 2, consider adding some hedging or some other strategies to your portfolio.
I would encourage you right now, at the beginning of the year, it's still early, to also revisit the contributions that you're making to your portfolio. Over the years, as you have earned more money, have you kept on putting some upward pressure on your contributions? Because as you've earned more money, you've also been spending more money. Your lifestyle may have crept higher. The needs for your retirement in order to maintain that lifestyle may be greater now than you ever imagined before. And so with that greater income, you also need to be contributing the right amount so that your goals remain achievable for you.
That's right. So those are 3 action items. There may be more. But I would start with, you're investing for a reason. Make sure that reason is grounded, or your investing approach is grounded, not in emotions or not on a coin flip, going back to the beginning of the show, but more on your plan and your goals and working with your CFP. So that's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at Korhorn Financial Group, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.